Toby Mathis from Anderson Business Advisors here, and I am just going to introduce this very powerful webinar that I did with accountant Eric Oliver. Like, we've been doing this for more than 20 years, and I can tell when there's a topic that actually hits, that's very relevant and resonates with people. And this particular topic is on doing something called cost segregation with real estate. And the big question is always who benefits from this. And the answer is really anybody who has investment real estate. And the big factor was under the Tax Cut and Jobs Act, we had two major changes that impacted real estate investors that flew completely below the radar, where I'm talking 99% of the CPAs don't know this stuff is out there. And what those two things were was, one, bonus depreciation on assets that have a usable life less than 20 years, and the fact that those assets don't have to be new and put right in service. What really happens when you do this is you're able to take an asset that normally you'd be spreading out the deduction that you would get every year. You'd be taking a smaller deduction every year over 39 years for commercial property, or every year for 27 and a half years for residential property. And you're accelerating it into 1 year, 5 years, 7 years, 15 years, but you're actually able to allocate it out. And if you want, you can take anything that is below 20 years and jam it into 1 year. The results are extremely powerful for investors. Like, it can literally knock out large, huge chunks of tax liabilities if you do this right. The reason most folks don't know it's out there is because it is very new and because it's so focused into one area, that little niche area of real estate investing. And so watch this webinar. It's actually a recording of the webinar. And if you are a real estate investor, then don't pass up the opportunity to run those numbers absolutely free at the end of the webinar. Hey guys, this is Toby Mathis, and I'm joined by Eric Oliver. Eric, welcome.
Thank you, Toby.
And you're listening to a webinar on the new tax laws and how the new tax laws, the Tax Cut and Jobs Act to be specific, how it impacted real estate investors and what it gave us. Like, they gave us a huge, big, fat, wonderful deduction, and just not a lot of tax preparers are aware, or they use this, hey, it's not for the typical real estate investor. So we're going to go over that today. I'm just going to go over today's agenda right out the gate. You just heard from Eric. Eric's an awesome dude. In fact, I might just want to introduce Eric now so you guys get an understanding of just how extensive Eric and his firm's involvement is in this area. Eric, you still out there?
Yeah, I'm here, Toby.
Fantastic. So, Eric, there's lots of accountants out there that do this stuff on the side. Sometimes they're going to try to do this. Like, I don't do cost segregations. I use outside folks like yourselves. How many cost segregation studies have you guys actually done for taxpayers?
We're close to 5,000 now, Toby. We've been doing it for about 10 years. This is all we do is cost segregation. So we're kind of a niche in terms of accounting firms. We don't do tax returns or audits, anything like that. It's just cost segregation.
All right, and I'm going to make this real simple. When we say cost segregation, we're really talking about a change of accounting method that you're allowed to take, and it'll make sense once we go over how depreciation works, how buildings are different than personal property. We're going to go over 5, 7, 15, 27 and a half, and 39-year property. We're going to go over IRC, which stands for Internal Revenue Code, 168, and the bonus that was created under the Tax Cut and Jobs Act. So that's the new tax laws, Tax Cut and Jobs Act, what was passed at the end of 2017. Who benefits most? And we're going to go over some actual case studies because this is actually a huge impact. And there's already a ton of questions. Yes, you're going to, this is going to be recorded. And yes, we will be talking about the second year and how it affects year 2 and 3 and 4 and all that. And so we're going to go over that.
And then Carolyn, what was your example? I think she said, feel free to use my example. I believe, if I'm not mistaken, did you save 81,000 off of this and 188,000? Was that $188,000 deduction, or did you save $188,000 in taxes? This is one of our audience members deduction, so that's going to save you. I'm assuming $118,000. Holy schmoly! So Carolyn, Susan or Patty's going to reach out to you because I want to see what your study is. And great job, great job. And that's exactly how this stuff works. It's super powerful. So we're going to dive into that. I'm going to be interviewing Eric because he's an accountant who's an expert in this area. I am just a tax attorney who likes to own real estate and likes looking around for things that keep money in my pocket. And this is one of the huge ones. And I'm still shocked that people aren't catching on to this. And here's the beautiful part. It's not too late. So I'm going to jump on in. So we're going to go over what is depreciation, what period of time you take these things, what type of property, and who can depreciate. Eric, what is depreciation, if you don't mind answering for us?
Yeah.
What is it?
Yeah, so the IRS allows us, anytime we purchase investment properties, any property that's generating revenue, whether it's a home office, a single family rental home, duplex, office space, what have you, anything that generates income, you're allowed to depreciate that over either 27 and a half years for residential or 39 years for commercial property.
Mm-hmm.
And what that gives you is, as you know, Toby, a lot of people invest in real estate for the tax write-offs. So it allows you to take a portion of your building and expense it every year for wear and tear. So just to make the numbers simple, if you had a $270,000 rental home and you're depreciating that over 27 and a half years, you're going to get about roughly a $10,000 write-off each year to write off against your income.
Mm-hmm. So it's basically, so I kind of put my own definition. It's basically an income tax deduction. And it allows you to take that against any of the income that's generated. What period of time do we usually do this? I know that you just mentioned 27 and a half and 39 year, but are there other properties that have different time frames?
There are. So you've got your 5-year property. Those are the stuff that's typically inside the building, things like carpet, countertops, cabinets. You've got some 7-year stuff. We don't see a whole lot of it, but some of your 7-year stuff is things like telecommunications.
Mm-hmm.
All your land improvement are 15-year assets. And so those can be depreciated over 15 years. So those are the three main categories that we segregate into. That's the 5, 7, and 15 year.
Mm-hmm. So we're going to go over, there's a bunch of questions already that people are asking. And so I'm just going to kind of go through this. When you're taking depreciation, it doesn't have to be just that property. And man, there's a lot of questions rolling in, by the way. We probably have a good 40 or 50 questions already. And we're going to answer it in this, in the webinar. It's designed to kind of go over this. But the default is most people just go and have real estate offset real estate income. And that's because real estate income is considered passive. And there are exceptions to that rule, which we're going to go over. And so the first inclination is people usually say, oh, I don't need extra depreciation. Why would I do it? And that's because they don't understand the exact benefit. As for what property, it's tangible property. It's the structure. You cannot depreciate land. There's a couple exceptions like an oil and gas and things like that. Where you're depleting, but you don't depreciate land ever, but it's going to be the structure on it and then the things inside that structure. As for who can depreciate, it's the owner of the property. Now let's go over the types of property because you have buildings versus personal property. And as Eric was just saying, hey, there is residential or commercial real property, which is the difference is whether it's 80% used for dwelling or whether it's commercial or hotel. And then you have personal property, which the personal property, the IRS has a publication where they say, here's how long things will last. Like, for example, carpeting might be, is going to have a lot less useful life than a building structure. or you're going to have certain software that might have a less useful life than a tree or shrubbery, things like that. Let's kind of go over a few of these. And Eric, I'm going to ask for your help on this. I'm just going to throw these up here, the different types of properties. This is the stuff that's usually inside of a business or a building. And you're going to see that we're focusing on, in this particular webinar, we're going to be really focusing on real estate and the areas that are in the real estate. And I know there's already a few questions out there as to solar and things like that. Solar is both. Solar is going to give you a tax credit for buying solar, and you're going to get to depreciate it. Your depreciation isn't 100%. They let you write off 85% in the case that you took 30% tax credit. Now, I'll unpack that in a second, Kevin. That's who's asking that question. But you're going to get a huge benefit. Like solar gets me even as excited as this, but that's not the purpose of this webinar. This webinar, we're really going to be focusing on these 5, 7, and 15-year properties, and as they relate to a building. So Eric, will you help me with these and get my mind around what is 5, 7, and 15-year property?
Sure. So your 5-year property is typically found inside the building, and those are, like I said, are things like carpet, flooring, window covering, appliances, lighting, crown molding, countertops, cabinets, a lot of the interior stuff. The rules behind that, if we can easily remove the property without damaging the structure, chances are it's 5-year property.
Mm-hmm.
So again, if you take carpet out of a building, it's not gonna, the walls won't collapse. And so carpet, for example, is a 5-year asset. The IRS says that you'll replace your carpet on average every 5 years.
Mm-hmm.
So that's kind of the 5-year property. And then your 7-year, like I said, we don't run into a whole lot of 7 years. Some of the telecommunication stuff is typically what we see in commercial and residential rentals. So sometimes it's 1% of what we segregate out, but there still is some 7-year property. And then another big category is the 15-year, and that's all your land improvements. So those are things like asphalt, sidewalks, curbs, gutters, irrigation, retaining walls. We'll go out and count trees and shrubs. People look at us and they're like, what are you doing? We're like, these are tax write-offs. These trees and shrubs, the IRS says these last 15 years and we can put a value to those. Let's depreciate those over a shorter term. So all of your land improvements, some big ticket storm drains. If you've got storm drains, those are in your property. Those are big. Swimming pools are interesting. If you have an outdoor pool, it's a 15-year asset. If it's an indoor pool, it's a 39 or 27.5-year asset. So if you're going to build a pool, build it outside because you'll get better write-offs. But that's kind of your 5, 7, and 15, some examples.
And let me just break out why this is important. Because if you don't break this out, it's going to be considered 27.5-year property or 39-year property. In other words, the default when you buy it, you're going to be treated as though, if you buy a building, for example, even though it has carpeting in it, even though it has office furniture and fixtures, even though it has an electric system, you're going to be treated as though all of that is 39-year property. That's the default, and that's what everybody goes with under the Modified Accelerated Cost Recovery System, or MACRS. Quick question, Eric, because I'm getting a ton of these questions. Somebody's asking about decks, water heaters, HVAC, all these things.
So all of those have, again, and I think you might have mentioned, Toby, we have a book that's, I don't know, I think it's 1,700 pages. The IRS has basically outlined every single one of those components. So for example, decks are, and we've seen decks that have been classified as structural, and we've also seen decks that can be classified as land improvements. So it really depends on the structure itself. Again, can it be easily removed without damaging the building? Are there awnings? There's different things that we do, or cost segregation companies will do to identify whether or not those can classify as 15-year property. HVAC systems are kind of interesting. The heating and cooling to cool down a building is not a short-term asset property. But let's say you have cooling to maybe cool a room full of servers. Or, for example, we did a meadery up in Prescott, Arizona, where they produce mead, which is an alcohol beverage, fermented honey. And so they had barrels and barrels of honey, and they had specialty cooling equipment just to keep that honey at a certain temperature. And so that, because it was unique to that business, that cooling equipment, we were able to take and put it as a shorter asset life. But typically your standard HVAC, just to cool down the building, that's considered one of the building systems, and it's a 27.5-year or 39-year property. So it really depends on the situation, and that's why CPAs can't easily identify these items, because they don't always have the constructional engineering side of things to be able to identify and reverse engineer these buildings.
Wow. So yeah, so the HVAC, I think that there were some areas where you could try to 179 it, but for the most part, no, you're not going to get to. There's so many people asking the HVAC question. Usually, it's part of your building, and you might get an energy credit on it, depending on what you're putting in there. But I don't think so. I'm trying to think if there's another one out there. I'm reaching back in the recesses of my mind. I know that 179, which is up to $1 million, you can use, or I know for 2018 you could. So I know it just says HVACs don't last 30 years. If you know what that does, let
They
us know.
absolutely don't. That's true.
HVACs, I get it, but that's why what you're going to do is you're able to write it off up to $1 million of it in year one with your bonus depreciation, not bonus, your 179 deduction. So I'm going to show you that there's two areas. So we're going to get into this. We're going to be dealing with two sections tonight. Or really the big one is 168, which is the bonus depreciation. I'll show you how that works and how it applies to this, but that doesn't mean there's not some other options still out there in our toolbox. And you're going to see if we can't get it one way, we're always going to get it another. But let's just keep jumping on. You guys will get this. This webinar is designed to answer your questions. So a lot of you guys are answering a bunch of different questions like, hey, can you do it on rental? Can you do it on condos, restaurants? What about a hot tub? That's awesome. Somebody says hot tub. And somebody says, what about the $2,500 repair? You don't have to worry about depreciating something if it's a repair. And yes, you can do the 2,500 threshold. But we're going to keep going through this. Let's go over the different types of property, because and I'm not going to make you guess on this. I'm just going to throw it out there. The 27.5-year property, as Eric already laid out, was residential rental property, where 80% or more of the gross rents are from dwelling units. And a lot of folks think, well, what about a hotel? Well, a hotel is commercial because the dwelling units, it requires a stay of greater than 7 days. So hotels are transient, so they're going to be considered commercial rental property. In fact, Airbnb is quite often, that's the big debate, is whether it's commercial or residential, even though it's just people staying there. So it gets kind of fun. There's a lot of questions here on whether this will be recorded. Yes, it's recorded and you'll be able to get it. The other thing is, based off that 168 bonus and section 179, yes, you're able to do both. You can only write it off once. So, but we're going to keep getting into that. You guys just chillax. I'm going to jump into the 168. Can you tell me a little bit about section 168? I'm going to throw up some information so people can see it. But Eric, what do you think? What is 168?
So yeah, it goes back to the bonus depreciation, and bonus depreciation has been around for a number of years. It's kind of the government put it out there to kind of stimulate the economy back in the early, when was it? I don't even remember when it initially started. It's been around a while though. And every year they would change the bonus amount. Sometimes you would get 30% bonus, then they would wait till December, and then they'd say, okay, next year we're going to give everybody 50% bonus.
Mm-hmm.
And there were some rules that applied to that. The asset life had to be less than 20 years, and it had to be new construction or new use. And so that limited, if you think about commercial property or residential rentals, those are depreciated over 27.5 and 39 years, so they don't qualify for bonus. However, if you were to do a cost seg study, now you've taken that 27.5-year asset, you've divided it up into those different categories, and all of a sudden your 5, 7, and 15-year assets are eligible for this bonus. So that's kind of the old tax law. The new tax law, the two main changes, one is they went from, in 2018, it was supposed to be 50% bonus. They've changed that to 100%. So that's a huge difference. That's basically writing it all off in the first year. The second thing is they got rid of that clause that said it had to be new use. So now I don't have to go build a building to be able to be eligible for bonus. I just have to go buy a building. So if I buy a building, even if it's been around, even if it's a 20-year-old building, and have a cost seg study done, I now get to take 100% of my 5, 7, and 15-year assets and write those off in the first year.
Mm-hmm.
And so,
This is
Toby,
huge,
we're
by the way.
honestly, yeah, it's huge. We're creating deductions people can't even utilize at this point because.
Eric, let me interject because I'm getting a whole bunch of questions on this. A bonus depreciation. What this means is that if you had 5, 7, or 15-year property, that you can elect, instead of writing it off over 15 years, you can elect to take up to a 100% bonus this year of depreciation. In English, you can write it off in 1 year, even if you haven't paid for it yet. What that means is that, somebody says, can you elaborate? You can actually write it off in year 1. I don't know, like it's a deduction. I don't know what else I need to elaborate on. You can write it off. You get a huge tax deduction because you have a building and you're figuring out what portions of it is 5, 7, or 15-year property. This is massive, guys. This is going to be huge, and I will give you guys examples. All right, so what property gets the bonus? Tangible property, 20 years or less recovery period. So everything we just went over, you could write off in the first year. So everything that we went over there in the 5, 7, 15, and this is so huge. An example would be great. And how we're going to go over 3 case studies, guys, and I'm going to show you exactly how it works.
Hey,
Can this
Toby,
be used? Go ahead, Eric.
Yeah, sorry to interrupt. I just wanted to mention that this tax law did take effect on 9/27 of 17. So anything purchased after September 27th of 2017 is eligible. So if anything purchased before that, it falls under the old tax law, but anything after that 9/27 date is eligible for this new 100% bonus depreciation.
And so like for 2014, it might be 50% bonus depreciation, all those things,
Correct.
right?
Correct.
And it's, do you have to take 100 or could you take 50 if you feel like it?
No, we quite often, so the IRS, I think they knew that these deductions were going to be massive. And so they actually added that you can opt out of the 100% bonus and just take 50% bonus. You can even opt out by class life, meaning I'm not going to take bonus on my 5 and 7. I'm just going to let those depreciate over the standard 5 and 7 years. But I'm going to take bonus on my 15-year assets because I don't plan on holding my property for 15 years. So I'm going to bonus the 15-year assets, take that right off in year 1, and let my 5 and 7 depreciate over the 5 and 7 years. And so it allows you to really spread it out and be flexible with what kind of deduct. We work with CPAs and say, where do we need to hit? What is your income? And then we've got all these different tools to be able to take bonus on this, opt out of this, and we can usually come up with a deduction that offsets most of your income.
Yeah, let's go over like where this really benefits. In fact, that's a slide, so you guys will figure this. And don't worry, we're going to go over examples, guys. We're going to go over exactly how it works, and we're going to go over how is it different than Section 179. 179 is only for equipment, and it's capped at $1 million. This is bonus depreciation. You don't have to worry about it. And then if you recapture 179, it's if you use it less than 50% for business, it forces you to recognize it all as ordinary income. So 179 is neat and dandy, but it has a nasty surprise for you. So we don't want to use 179 if we don't have to. All right. So who benefits from this? So first off, you have real estate professionals. And the real estate professionals, those are the folks that are involved in the real estate development, construction, sales. They have their own properties sometimes, but not necessarily. And they qualify underneath this test as a real estate professional under Section 469, which says that real estate losses are passive and you cannot offset your, for example, your W-2 income with your real estate losses. But that's not a 100% rule. There's an exception, and one of those exceptions is real estate professional. In order to do that, one spouse, if you're married filing jointly, has to hit 750 hours in real estate activities, and it has to be more than 50% of their personal time, like their work time. So if they are working at a job and they're working 2,000 hours full time for somebody else, they would have to do 2,001 hours to qualify as a real estate professional, which means it's not going to happen. They also, so one spouse could hit the 750 hours. So think of this. Let's say husband and wife, husband does real estate activities, qualifies, spends 1,000 hours going on real estate. Wife is a doctor, spends 3,000 hours doing medical. Only the husband would have to qualify as a real estate professional to make these things work on their returns. Then they would also have to materially participate with their real estate. And here's the big one: you can group all your real estate activities together. What that means is, let's say you have again husband and wife. Let's say wife makes $1 million, and husband is able to generate $200,000 of losses because they take rapid depreciation on their real estate. Let's say they bought a $700,000-800,000 worth of property, and they took a big, fat, huge deduction. Then that deduction is going to come over and wipe out the $1 million of, so let's say it's 200,000. It's going to take $200,000 off that million, and so you're going to get a $200,000 tax deduction. That's pretty huge. The other deal is self-rental, and Eric, you're going to have to help me on this one because you've done a bunch of these. But let's say it's a doctor, a group of doctors, and they buy their own building and they rent it to their active business. Can you use the cost segregation and the rapid depreciation to offset their medical office income?
Yeah, so there is a grouping allocation. There are some rules with it. The ownership has to be set up the same way. So let's just say I have a partner, and me and my partner own the building 50-50, and we also own the operating company, the medical practice 50-50. Then you'd be allowed to group those two activities, and we would do a cost seg study on the real estate and take those deductions to offset the operating income. That's the big thing, is they have to have the same type of ownership. And then you also have to conduct business out of that building. So another example, we did one for a roofer who owns a roofing company, but also owns a warehouse where he runs the roofing company out of. So we grouped those two activities. He's 100% owner in each of those activities, or in each of those entities, excuse me. We grouped those two activities, did a cost seg on the warehouse, took those deductions to offset his operating income. Mm-hmm. So that's a great way if you own the building and you're operating out of that building. Another great way to be able to use these deductions.
That's huge. So it can offset that active income. Somebody's asking whether you can do this for Canadians on their U.S. income. I'd imagine that you could, but have you dealt with that?
I believe you can. We've done some rental properties, I know, in Mexico.
Mm-hmm.
And so, like I said, they were getting U.S. income. So I believe so. I don't see why you couldn't.
I don't see why you couldn't either. So somebody says, why would you do 50% when you could do 100? Here's why. Because let's say you're a landlord and you have profit, and let's say you have rentals that are making you $20,000 a year that's going into your highest tax bracket. And all you really need is $20,000 a year in deduction. Then you might just take enough bonus depreciation to offset it, because otherwise you take it all in 1 year, you can carry it forward. But in some cases you're looking at this, and there's something that you got to understand about recapture. You don't pay gain on carpeting. It's 5-year property, right? If you're going to hold your property for, let's say, 7 or 8 years, and you depreciate your 5 and 7 year property to zero, you may choose to only select those for your cost seg because there's no recapture. That's all now capital gains. It's really kind of evil the way they set the system up. If you sell a building and you're doing recapture, which is taxed at the highest of 25%, it's your ordinary bracket capped at 25%, you're paying that on carpeting and assets that are not worth anything. They have zero value. In other words, somebody doesn't buy your building for the carpet. They're going to replace that thing anyway. You're paying recapture at 25% on something that should be taxed as long-term capital gains at a maximum of 20%. If you don't separate it out, you're going to be paying the higher amount. Now, this is a reason why you might select a lower amount because you may only want to rapid depreciate the 5 or the 7-year property. You may not want to depreciate the 15-year property. You're going to say, hey, I'm just going to pay tax on, I'm going to depreciate it normally and I'll pay recapture on it, or I'll pay the ordinary income on a portion of it. And it's still based off the calculations, and we'll show you how these things work. It's still going to be better off for you. And I'll show, in fact, we're going to show you a case where somebody did the cost seg right before they sold their building. So we're going to get to that one a little bit. The other thing is if you're selling with profit. So you have a building that has $1 million of profit. I think, is that the example that we have? We had that I think you sold it for $3 million. So it was about $1 million of
Yeah,
profit.
I think it's 800,000 of capital gain.
800,000. What Eric's group did was did a study on it just before they sold, and it was able to offset. So it's pretty cool. So again, we'll get into these, and so I want to jump into these case studies. I'm just going to put a caveat that these are for educational purposes only. These are actual cases, so we took names out, but you're going to see the numbers and exactly how they worked. Hopefully, I don't think we have addresses or any identifying information on it, but these are actual case studies. And we'll make sure. Somebody says they're in a thunderstorm and the power just went off. Now it's back on. Yes, you'll be able to get a recording of this. All right, so let's go through these, Eric. These are fun. So can you go over this study that you guys did?
Yeah. So one of the big misconceptions around cost segregation is it only applies to new purchases. You have to do it the year you purchase the building, and that's just not the case. So this is an example of what we call a look-back study. It was for a couple in Phoenix. You can tell there by the rocks there in the garden and no grass. But basically what it was is they built this property in 2014. So this fell under the 50% bonus under the old rule, and it was eligible for bonus because it was new construction. So it's new to them, new construction. So it's 50% bonus. The construction costs were about $280,000. That doesn't include the land. And like I mentioned, it was eligible for the 50% bonus. What we did is we go in, even though this building has been in service, it was a rental, it's been in service for 4 years, we were able to do the cost seg study. And of that $280,000 construction cost, we segregated out 34% of that into shorter asset life. Again, 5 years. So we went in and we said, okay, these cabinets, how much were these cabinets? We put a value on those cabinets. We do it through construction costs. We've got some costing software, put a value to the asphalt, the pavement, and we were able to do that and put those into shorter asset lives. And the result of that was we increased the depreciation on their 2018 tax return by $66,914. And so this was a tax savings of approximately $23,420. That was calculated at a 35% combined rate. And so that's just a massive saving. Again, a study like this is probably going to cost you maybe between $2,700 and $3,000, but you're going to get about depending on your tax bracket, anywhere from a $20,000 to $30,000 tax savings.
I'm going to point to this. This was a property purchased in 2014. The reason this is really important is because when you guys did the study, here's the numbers. This is the actual numbers off the study. And somebody's asking, hey, what if I want to do my own study? You don't. It has to be a professional. You have to use somebody that knows how to do it. Like, I suppose that you could try to go on the cheap and use your CPA or something like that, but I don't suggest it. I don't do it.
Yeah, most CPAs won't do it. They've got the tax knowledge, but they don't have the ability to go in and put a value to all these different components. Even on new construction, they might have the value of the appliances, for example. But one of the things we segregate with the appliance is the plumbing and the electricity going to those appliances. So the IRS says all the electricity going, like you think about an apartment unit, all the electricity going to any of those appliances, which sometimes can be 40 to 50% of the electricity going into those units, we get to take that, put a value on it, and use that as a 5-year asset. The only reason there's a plug in the laundry room that's that size is because you're going to put a washer there. And the IRS knows that, so they allow us to take portions of the electrical and plumbing. So there are some CPAs out there, especially on new construction. They'll pull some of the easy things off of the construction docs, the costing docs, but typically they're segregating somewhere between 10 and 12%, where if you pay to have it done, the additional savings, we're going to segregate 30 to 35%. It's going to far outweigh the cost of the study. And like you said, the first thing the IRS audit guide says is it has to be done by a qualified engineer. And so,
Yeah, so there's a bunch of questions that are out here. I'm just going to shoot through them real quick.
yeah.
First off, there's a lot of comments out there that it's not advantageous to do cost seg on single family house and ideally for larger properties. However, you can do a case study on single family. My vacation rental property was about 125,000 in renovations. Yes. I then have them all categorized. Would this be sufficient to get a 100% bonus? So if somebody did a fixed up a property where they just did a renovation, are they able to break it? That makes it really easy to do the cost seg study, right?
Yeah. So again, they'll be able to pull apart the easy components, things like they'll have an invoice and they'll know that they spent, $6,000 for carpet, and they can put that carpet on the depreciation schedule as a 5-year asset and take 100% bonus. Absolutely. But there are going to be a number of items that are going to be missed. And that's, again, why it's important to just have a professional do it. You don't want to take, you're leaving money on the table by not having somebody do it. You'll be able to pick those easy things, but you won't be able to put a value to what was the plumbing that went into the new sink in the kitchen. How do you put a value to that?
Yeah. So what you're doing, and I'm just writing it up on the board before we go through these numbers, you're making a change of accounting methodology. You're pulling yourself away from the default rule and saying, hey, I want to break these out by their useful life instead of just going off the 27.5 years or the 39 years. So the 27.5 years should be a clue to you guys. Yes, you can do this on residential property. This does not require a C Corp. Is this additional tax saving, or is it basically getting money back a few years earlier? Both, sometimes. Worst case scenario, Eric, you always say this, worst case scenario is you're getting an interest-free loan from the government for many, 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 many years. That's the worst case scenario. Best case scenario is you're saving yourself, like in this particular case. So I'm going to use your example. What they did is they said the accountants broke this thing down, and I'm going to use a little highlighter. If you see in year 1, they got a $23,000 tax savings, but then they go and they say, what's the net present value and what are you actually going to be recapturing? And so what's the total benefit to you? So in this case, the folks used, how much was that cost seg on these guys? About $2,700?
$2,750, yeah.
Right. So these guys, for $2,700, they netted out tangible benefit in their pocket of 13,000, almost 14 grand. Plus, they had use of the extra money, that extra 10 grand, for God knows how many years. You can actually see the breakdown over here. This is the cost seg study. This is without. So I don't want to belabor the point. What they were able to do is front load what they would have. This is the depreciation without the cost seg right over here. This is what they were able to do. They would have gotten a $5,091 deduction. And what they did is they just went bam and got, they were getting a 57. But since they did it in 2018, they increased their depreciation by 66,000 in 2018. They captured all the stuff they hadn't already taken, and they just grabbed it this year. And then some of you guys are correctly noticing it's going to lower the amount of depreciation over the rest of the life because you just took a huge amount. But at the end of the day, it's about calculating this thing and being honest. You increased your depreciation by 60 grand in years 1 through 5. Then over the entire lifetime, if you own this thing for 27.5 years, which, let's be real, a lot of you, we're not going to do that necessarily. We always say we're going to, but then the average person turns their rental properties, I think it's still like 3 years, but let's just be generous and say 5 to 7. Hopefully it's at least 7. There's still other tax benefits, which is what we're going to show you. Why is there such bad information out there, Eric? Why do accountants not get this?
I think then this kind of goes to the question that said it doesn't always make sense for residential rentals. And I'll say that we do a lot of training for CPA firms. We're accredited to give them CPE credit. And that is one of the biggest misconceptions. When this stuff first came out 10 years ago, 15 years ago, the studies were $20,000. So in order for it to make sense, you had to have enough tax savings to offset a $20,000 study. We do single family rental homes in the middle of Tennessee that they purchased for $70,000 under the new tax law. We'll do those studies for $1,500 and they'll save $10,000 on their taxes in the first year. So I think the miscommunication or the misinformation is a lot of CPAs, a lot of tax advisors still think, I hear it all the time. I talked to my CPA about this. They said it doesn't apply to my 5 duplexes because they're all under $1 million a piece. And a $10,000 tax savings for somebody who owns a duplex is just as good as a $100,000 tax savings for somebody that owns, a 100-unit multifamily. So I think that's the biggest misconception is it doesn't apply to smaller properties, and that's just not the case. The studies have come down, the prices come down. 2 factors. One, the prices come down, and now the benefits have gone up with the new tax law.
All right, so I'm gonna hit a whole bunch of questions here, rapid fire, guys. Leo, your taxes are due on 10/15/2019. You can still do a seg study for 2018. Yeah, you could always just do 2019 and capture what you didn't take in 2018 and 2019 also. Can I do a cost seg on a property? I live in one of the rooms. Yes, you can. You're just not going to get to take the full amount. You're just going to have to. You're going to take a portion of the depreciation that's for the resident, for the investor. Is cost seg applicable only to real estate professionals or to any investor? It's on any real estate that's investment real estate. If you sell the property, do you have to repay the bonus tax? No, you recognize it as realistically, and you'll see this, it'll probably be long-term capital gains. It's going to be better than recapture, and I'll show you why when we do our third study. Is it available to C Corps or individual investors? Both. Is the new tax law, is there any benefit to properties bought before 2017? Chintan, we just showed you an example where we bought the property in 2014, so yes. Are you going to do a cost seg on your individual residence? No, unless you're going to rent it out. Is it wise to depreciate the asset class based on the number of years you plan to hold the property? For example, if my plan is to hold it for 4 years, is it best to depreciate the 15-year asset? No, I'd probably do the shorter. I'm going to answer for you, Eric. I'm assuming that's right.
Actually, Toby, I would do the 15. I would take the bonus on the 15 because your 5 and 7 will almost be fully depreciated after.
Oh, you're depreciating it anyway. Yeah. So you're jamming
we
it.
do that quite often for investors. If they always want us to take if they don't want us to take bonus on everything, we always start with the 15 year so they can realize all those deductions in the first year.
I'm thinking about if you sold it, then you don't have to worry about the recapture because 4-year property is pretty much worthless. You're only going to have 1/5 of the carpet that you actually have to recapture on. What about depreciation recapture? Doesn't that result in higher tax since you're? No, George, I'm going to show you the example when we show doing a cost seg right before it. It's a misnomer. Accountants are lazy. They don't like doing the calculation. If they do the calculation, you're going to see almost always these things are in your benefit. What is the cost of a cost seg on 2019? A property worth about 400 grand. I know you can't just do it. I'll show you guys a way where you can get this a free analysis done, and he can actually give you a quote. But on a $400,000 property, what's the typical cost seg cost?
3,000 maybe.
Yep. So you're gonna want a 7 or 8 or 9, 10% times return on these things. If I take depreciation, I'll need to pay back the tax when I sell the property. Sometimes, but usually not, depending on the length of the property or of the asset that you depreciate. So example, I use carpeting. Carpeting is going to last for 5 years. If you rapidly depreciate it, that carpet is worthless, which means you're not going to pay gain on carpet that is worthless. You're not going to recapture on carpet that is worthless. Is this good for multifamily units, 5 or more? Yes. Just joined, I never mentioned the name of the cost seg firm. It's Cost Seg Authority. That's where Eric, and I'm going to give you all of his information. And then we're keep getting tons of questions. So let's go into this next one. Could you go over this duplex remodel? This is an interesting case where they were able to get I was really taken by the amount that they were able to depreciate on something that they rehabbed. Can you go
Sure,
through this one?
sure. So on this one, so the couple actually purchased the duplex in May of 2018. They had some tenants who were living there. Once the tenant's lease was up, they actually rehabbed the property. So the original purchase price was $315,000. The remodel cost was about $85,000. Again, the remodel was completed that same year. Because both the original purchase and the remodel occurred after that September 27th, 2017 deadline, both of those were eligible for the 100% bonus depreciation. So
Yeah.
on the original purchase, we segregated 31%, and then on the remodel, we segregated close to 43%. So total, the increase in depreciation was about $120,000 in the first year.
Mhm.
And that was made available to them on their 2018 tax return. They were at about a 32% combined rate, so that's a tax savings of about $38,451.
How much did it cost them to do that cost seg study?
That was, I think, like 32, 33 maybe, between 32 and 35.
100?
Yeah,
See?
that's a 10 times return on this specific example.
Mm-hmm. Isn't that wild? A lot of people, again, are thinking, hey, this is, here, I'm just going to circle that. This was a 38,000 and it cost them about, what did you say it was?
It was 30, I think it was 3,500, 3,450, something like that.
So it's about 3,500 bucks, and this is money in their pocket. This isn't the tax deduction. The tax deduction was 120,000. The money in the pocket was closer to 38,000. Here's the actual numbers on that, by the way, and I'm stealing your stuff.
No,
and somebody says, can you do this on flips? You're not going to do this on a flip because it's going to be added into your basis. You're not going to be depreciating. Can you do a cost seg on a property that's not earned income yet? Yeah, I don't see why you couldn't, but you have to have something to offset. Okay, let's keep going through this. So you had the taxpayer's marginal rate was 32. So if you're in a higher or lower, then this would alter this. This is why you actually do the study on yourself. You increase the depreciation. Wow, I'm looking up here. The total depreciation was 101, so the increased depreciation from this number to the 96, or excuse me, to the 101 was 96,000.
right, and this is just, Toby, just so you know, this was just on the original purchase. So if you see there on the left, it says cost of property. This was just on the 315,000 original purchase. Something else to note here, Toby, you'll see in that green section there at the top where it says 5-year. If you remember on that last graphic we went through, that 5-year stuff was depreciated over 5 years. You'll see on this one that because that 61,000, because this property falls into the new tax law, that 61,000, the 3,100, and the 28,000 all gets depreciated in year one, and that goes back to that 100% bonus. So we still have the same amount of depreciation at the bottom. If you look at the bottom, it says 315 in the green section in the bottom right. And then it also says 315 under the depreciation without cost seg. We're still depreciating $315,000 worth of assets. We're just taking, in our example, by doing the cost seg, we get to take 100,000 of that in the first year. Versus taking the roughly, what is it, almost 11,500 per year over there where it says depreciation without cost seg.
Well, this is cool. A bunch of questions real quick.
Yeah.
Can you write off the cost seg as an expense?
Yes.
Does it make sense to do a cost seg on a property you've had for 10 years?
Yes. Well, I say yes. Always run the numbers first. So we do a free benefit analysis. Depending on the purchase price, the fee of the study, and the type of asset, typically yes, but we would want to run the numbers first.
Just remember the 5, 7, and 15-year property that you've been writing off over 39 years. You're going to take all that in year one, so it's going to be huge. Then somebody says, hey, how does that affect recapture? It's either going to be ordinary income or long-term capital gains. It's not going to be 1250 recapture.
Let me just add to that, Toby. Even if on the recapture, that's a question we get quite often. whenever you recapture, even if we were to recapture 100% of the depreciation we've taken. So we get that question quite often. People will say, well, why am I going to accelerate my depreciation if I have to turn around and pay it all back when I sell my property? And there's a couple of reasons. One is the time value of money. So a dollar today is worth more than a dollar 27.5 or 39 years from now. That's the first thing. The second thing is you take your deductions at your ordinary income. So for this example, your total marginal tax rate is 32%. We're taking these deductions at 32%. Even if I had to pay 100% of it back, which you're not going to have to, but if I did have to pay 100% of my depreciation back upon sale, I'm paying that back at a recapture or a capital gains rate of either 20 or 25%. So that's 7 or 12% difference. That's permanent tax savings that goes in your pocket.
Yep.
And then the thing that you alluded to, Toby, is you do have to pay recapture, but it's going to be on a lower amount at a lesser rate. And I think that third example we have, Toby, kind of walks them through how that works. But when you sell your carpet after 5 years, carpet is a 5-year asset. When you've owned the building for 5 years and sell it, your carpet didn't go up in value. So you don't have to pay, there's no gain on your carpet. And we'll walk through that here in a second, Toby, but just want to make it clear.
The next study is going to show that. Somebody just asked, what is recapture? When you take a deduction on something, when you sell it, ordinarily they call that 1250 recapture, which is taxed at your ordinary bracket, capped at 25%. In other words, if I'm writing something off that's giving me in my case, it's 37% tax savings for every dollar, I'm saving 37 cents. Then when I sell it, I have to pay 25 cents unless it's worthless. If I do a cost seg study, I can get that down to it's just long-term capital gains. Somebody says, can you still use a 1031 exchange? And somebody else had asked earlier, should they do a cost seg study right before a 1031 exchange?
We always recommend doing it after. I think the benefits are a little greater after. But yeah, it doesn't affect a 1031 exchange. I would, depending on the size property you're 1031 exchanging into, it probably makes more sense to do it on the second property than the first one. But we could walk through that. It's kind of a case by case on that one.
Yeah, and yes, you can use this. This is the depreciation is rental depreciation. So if you have rental income or you have gains from another property, you could take this depreciation and offset that other income. The other thing is these carry forward indefinitely. Is there any time periods, like let's say I had a massive deduction in year one of $200,000 and it offsetted my $20,000 of rental income. Is there any period of time that I'm not allowed to keep carrying that forward?
No. So under the new tax law, it carries forward indefinitely. Under the old tax law, it would expire after 20 years.
Yep.
But with the new tax law, you get to carry that forward indefinitely. So you'll offset your first 20,000 of income this year, and then you'll have 100,000 to offset income in future years.
Yeah. So this is.
Now, Toby, in saying that, if you only have, let's say we create a $600,000 depreciation expense and you only show 20,000 of income, then you're not going to pay us to do a study because there's no reason for us to accelerate it for you to then sit back and only take 20,000 a year and just postpone it.
It's
moving
worth
forward.
$7,000 a year on some people.
Right.
I'm serious. It just depends. And does it offset personal service income? Yes, if you're a real estate professional. So if you're not, then no, it's just going to offset your rental income. If you are renting it to yourself, so Tom, if it's your business and you have a LLC that holds your building and it's renting to your active business, then yeah, you can group those two together and you can offset your income from your other business. So there's different modals, different deals. It will not offset gain from stock market unless you're a real estate professional, in which case then it will offset all income. Let's go back to this one where you did the cost seg right before you sold it. So this is a good example. Can you explain this one?
Yeah, so this one's a little more in depth, but we'll do our best to walk through it. So basically what it was is a client had called us and they were talking about doing a cost seg on a new property they were going to purchase. And we got to talking and found out that he hadn't sold his old property yet. And I asked him, I said, have you considered doing a cost seg study? I kind of walked him through. And the way it works is in this example, they had purchased it in 13. In 2013, for a purchase price of 2.5 million. So it's an apartment complex. They purchased for 2.5 million. They sold it for 5 years later, for 3.3. So they had a gain of about 800,000 over the 5 years. And we completed the cost seg study, and we'll walk through the numbers here, but basically when all this stuff flows out, there was a tax savings upon sale of about 73,159. So when you sell a property, you have to pay, like Toby mentioned, you pay your capital gains tax, which is usually 20 or 15%. Sometimes it could be 0, I guess, but typically it's 20 or 15%. And then you pay a recapture tax. Those are the two taxes you pay upon sale. And by doing the cost seg study, even though it was right before the sale, and you're thinking to yourself, why am I going to hurry and accelerate everything if I got to turn around and pick it back up? Again, you're picking it up at a lower rate on a lesser amount. And Toby, if you can just go to the next slide, I'll kind of walk through those numbers.
Yeah, I was answering a bunch of questions. We have a very active group here. And so how are our capital gains taxed? It could be 0, 15, or 20%. Yes, you could do these. Eric's firm can do this. They have a national group, so they can do this before October 15th in any state. Yes, you could still do it, but you always run the numbers first. I'll show you guys right after this how you run the numbers. So go through the numbers here, buddy. I'm sorry to throw this at.
So
a lot of emails.
So yeah, and like I said, there's a lot of numbers on this slide, and it took me 4 years to figure this slide out. So I don't expect you guys to figure it out in the next 30 seconds. But basically, the whole concept is remember, we owned this property for 5 years. So when we did the cost seg study, you have to pay recapture tax on the lesser of the amount of depreciation you've taken or the gain on the sale. And I'll say that again because that's really important. The lesser of the amount of depreciation you've taken or the gain on the sale. So let's just look at our 5-year property. Our 5-year property, after 5 years, we've taken all of the depreciation. In this example, there's a number there in that first green box all the way to the right of 425,000 under 5 year. So after 5 years, we took 425,000. It's fully depreciated according to the IRS. So the gain on the sale, by doing a cost seg study, it allows you and your CPA to manage the allocation of the sales price. And the way that works is, if you think about it, when you sold this for 800,000, if you didn't do a cost seg study, when you sold it for a gain of 800,000, if you didn't do a cost seg study, what you're saying is that 800,000, everything in your building went up in value by that percentage, whatever that percentage is. So you're saying my land went up, my building went up, my dirty old carpet went up, those old countertops went up, and that's just not the case. The land went up, the structure went up, but all your personal property on the inside, your carpet, your countertops, all that kind of stuff, that actually decreased in value. So there should be no gain on the sale of your old 5-year-old carpet. So again, by doing the cost seg study, at the end of the day, the most important thing for you guys to remember is I'm not going to sell my carpet for a gain after 5 years. Mm-hmm. By doing that, when you flush all these numbers out, you reduce your taxable gain and recapture tax on this property by about 73,000. And this is conservative, Toby. You'll see that over there on the top left, we've actually, even though we've had this 5-year property for 5 years, we still said, well, it's still worth something. We're going to give it a 10% valuation. Mm-hmm. And so you'll see where that correlates to, instead of 425,000, we're going to do it at 42,000. Right. And your personal property, your 5 and 7, is actually recaptured at your ordinary income rate.
He's going over here at the ordinary rates, capture at 37%. Like, he's showing what the amounts that you're actually recapturing. And at the end of the day, all you really care about is the how much tax you pay. Hey, I'm going to pay $285 if I don't do anything, or if I do this study, I pay $211.
Correct. And where you circled, Toby, that's the exact reason why. Instead of paying recapture on 425,000, I'm now paying recapture on 42,000, which again, that's conservative. We work with CPAs all over the country who will say, you know what, the IRS says my 5-year property is worth 0 after 5 years. I'm not paying any recapture on that. This is a conservative example, and so that's exactly right. When all those numbers flush out, Toby, you're basically shifting your gain over to the appropriate bucket, which is your capital gains bucket. And then the difference in rate is where you see your tax savings.
What did you guys charge for this, by the way?
This study was, I had it written down here, it's $6,200.
So that you paid, so somebody's asking that, 6,200 here, let me just write it down. If I could actually make my pen work, 6,200 to save about 70-some thousand.
Correct.
So not a bad return. Some of you guys would be excited for a 6% return. Here you got a, what is that, 110 times return, so whatever that is. Some of you guys are asking about the cost seg authority. Good timing, because I'm going to show you guys how to do it. If you want a 10 times return, you do a study. Here's where you do the study, and I'll show you exactly how to do it. This is free, and this is free because this is what these guys do all the time. You're going to go to andersonadvisors.com CSA. That stands for Cost Seg Authority, and they're going to do it for you for free because you guys are awesome and because we know you guys are going to actually do this because our guys, shoot, our customers rock. You guys are just mostly, a lot of the people that follow the tax and do the tax Tuesdays and all that fun stuff, you guys tend to be the mindset where you'll actually calculate things. And that's the rule, is always calculate, calculate, calculate. People are going to ask, well, what is the benefit to me? You got to know how much it's worth to you, like how much you're actually going to be able to get versus, and then determine how much it's actually going to put back in your pocket. So if you're not making money in real estate, for example, and you do a cost seg study, could it still put money back in your pocket? It depends on whether you're selling, it depends on where you're at, and you do not lose the deduction, it carries forward. So at a minimum, you're going to still have that loss when you sell the property. But let's just keep going through this. How much will it say? And by the way, the loss is an ordinary loss when you're selling an investment property, correct?
Correct.
Yep. So this will offset your other income, like your ordinary income. Somebody says, what about futures trading and all this stuff? Yes, this will offset that if you ended up with a loss and you sell, or if you qualify as a real estate professional. Now somebody's asking, what do you need to do the analysis? Here you go. It's 4 pieces of information, and I'll show you, it's on our website, that Anderson Advisors /CSA, and I think you guys should have that link sent out to you. I'll make sure you guys all get it. You're going to need the date you acquired the property, the price you paid for the property, the type of building, and what are the types of building you're looking for, Eric?
Any revenue generating, on the types, it's the type of building would be, is it a residential single family rental home? Is it a medical office? Is it, I think there's a list on the form.
Yeah.
They have it down. And
See, I just like putting you on the spot and seeing whether you can remember. And then address. See, I'm just evil. I know that if somebody did that to me, I'd be like, square box, roof. Yeah. What if I sold my property in the past May? Could you still benefit? Could you still go back? Like if they sold it in May of this year or last, could you still do a cost seg on that and attribute it to the property? Imagine you could.
Yeah, that's a great question. So the one that was sold this year, yes. If you haven't filed, then great, we'll do it. The trick is the IRS does require us to do a site visit on the property. So you do have to have a relationship with the new owners.
So you have to go in there and take a look at it. But yeah, I guess it sounds like you could still do it. How long does it take to do one of these analysis?
So the cost seg studies themselves take anywhere from 30 to 40 days from the time we get all the information. So the biggest portion of that though is setting up that site visit. So we want to come out, we have to come out, look at the property, send out one of our costing engineers. They go through the property, do takeoffs, take pictures, and then they come back. Once we get the information from them, it's usually 2 to 3 weeks to get the report out.
And here, really, I'm gonna make this easy for some of you engineers out there, because you're gonna say, well, it's 30, 40 days. How are you gonna get this thing done? If I tell you guys I want to do one for 2018, da 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 da. You can make a change of accounting election, the 3115, use a placeholder number, get the study done later, and then amend your return and grab the actual numbers if it's better than what you used as your placeholder. These guys will actually give this to you pretty quick though. Like how long does it take to actually get back an idea of how much is going to benefit them?
So we like to turn around the benefit analysis in 24 to 48 hours. So once I get the information from you and I've got everything, we'll put in some calculations and we'll get you, it's a very conservative number to say, hey, here's what the study's going to cost. Here's at what a minimum of what your tax savings would be. And then you can determine with your CPA when would be the best time to utilize those deductions, whether it's this year or hold off until next year, et cetera.
Yes, I have a few questions to go through here.
Yeah.
Well, there's only offset income if you're a real estate professional. Silvino, not necessarily. If you sell and you have a loss, you can offset your income. If you're a real estate professional, you can offset your active other income. Otherwise, it's just your rental income, and you can group all your properties together. What is step up? George, step up is, so somebody was writing in questions that I was answering about a step up in basis. So if you do a cost seg study, you own it until you die. Your property's basis, what you can start depreciating, steps up to the fair market value on the date of death. So you get to write it off all over again, or not you, but whoever you leave it to. Can bonus depreciation from rental property be adjusted against other K1 income?
Yes.
Yes. I'll make that real easy. If it was rental property, if it's K1 from like a S corp, then you'd have to be a real estate professional. Otherwise, if it's rental. What if I was clueless before I met you guys, never depreciated anything while I own my property for 10 years? Susan, the IRS makes you pay tax on that if you sell it. So you're gonna do this now, you crazy chica.
And Toby, I'll add to that. One of the great things is when you don't take depreciation, when we do the cost seg and we file that 3115 form, we correct all that. So
yeah,
it's a great opportunity. If you had a property, you haven't been taking depreciation on it, do the cost seg, let us fix it with that 3115 form, and then you'll be all square.
Susan, the IRS is mean to you. They make you pay tax even though you didn't depreciate it if you sell that property. So you're going to want to grab all that depreciation. A lot of accountants will say you can't, but you can. If you do a 3115, you can change accounting elected and grab all. Like, I think you're almost required. You don't have to do the cost seg to do the 3115, but you definitely want to take it. And this is worth a ton of money. Like, you're going to pay tax on that otherwise. What about a rental property that was purchased in 2018? We want to possibly retire in that property. So if you do this, can you still move into it?
Yes.
Yeah, absolutely. So I answered that myself with echoing you, jinx. All right, request a free cost seg benefit analysis. This is our website. This is what it is. And somebody is asking about a septic system. Do you know what the time frame of a septic system is?
I'm 95% sure that is part of the building, so it'd be 27 and a half or 39 years.
Yep. So, all right. So here's some fun ones. 9 out of 10, find our numbers easy to understand. So when you do the cost seg, it's going to be very clear. This is how much it's going to save you. If your tax bracket is this, we will be able to figure it out, or Eric's accounting firm will be able to figure it out. We have a great relationship with them, and they do the cost seg analysis. We do the tax prep with their 3115 and the cost seg analysis as is required under the law. 10 out of 10 will save money on who implement this. In other words, you're not going to implement this if it doesn't make sense. You're not going to do a cost seg and it's not going to benefit you. And remember, the rule for all things tax is calculate, calculate, calculate. Go to andersonadvisors.com/CSA and just see whether this is going to help you. There's no cost to it and nobody's hitting you over the head. It's just going to say, here's what you could do. Here's what you could benefit. And if you could benefit, let's say it cost you $2,000, it's going to save you $20. Then you could decide whether that's worth it. I can't make that decision for you. What if we borrow money to do the improvements? Is the interest included in the depreciation? No, you get to write off the interest and you get the depreciation. You get both, the best of both worlds. Regarding depreciation not taken for a property already sold, is it too late if that property was sold in 2018? Oh, yo.
No, if they haven't. Well, the answer is
they filed
no.
the returns. They filed the returns, but I think
you can
still
amend.
make it. Yeah. So Fabiola, you're going to need to do what's called a 3115 change of accounting method to grab that. Otherwise, you're going to pay tax on something you never wrote off, which is really bad.
Yeah, and that form, just to mention, Toby, that form would have to be filed before either the October 15th or the September 15th deadline. even though the cost seg study wouldn't be done by then, we would still want to file that form.
Yep, and you go back.
And we can work through that with her.
And then you can keep doing this. Like you could do this next year. You could do this. I just think that, hey, is there any reason why I would want to do a cost seg if I already have enough deductions to offset the rental income?
No, not unless you are a real estate professional or qualify as a real estate professional, because then you can offset your other
Right.
income.
And Daniel, unless you're renting it to yourself. If the property is held in a limited partnership, what's the implication to the limited partners? You're all getting your depreciation. So spread the word. All right, so you can go back. You can actually go back to 2016 and amend. So you want to make your change of accounting methodology. Like this is how long must a property be used as a rental to do this? There is no requirement as long as it's an investment property. As long as it's available for rental, you can do it. I have passively invested in 4 properties this year, which are taking the bonus depreciation. How can I qualify to write it off with my material participation? I know what I can't do. The IRS is good about explaining that. So Barney, it's going to depend on whether you qualify as a real estate professional. Your material participation, you can wrap all of your properties together to meet that material participation test, and there's 9 tests underneath that. So I can't just sit here and answer your facts and circumstances. It could be 0 time, it could be 100 hours, so long as nobody else is spending more than 100 hours. It could be 500 hours between you and a spouse, and then you'd also have to hit the 750 hour and 50% test, which we went over earlier. You can file and still amend a partnership returns. Like if you did this on let's say you did your 3115 and you're up against this September 15th deadline on a partnership, you could do the 3115 and then you could go and amend your return with the actual numbers. Is that a good way to put it?
Yeah, that's correct. Yeah, the tricky part right now as we approach these deadlines is the IRS requires that form to be filed in a timely manner by the end of filing date. So yeah, we just have to
So
file.
you got to do it. 2018 individual, you could still do that. Impartial election, you could do different asset classes. So you could do 5, 7, 15-year property. You could do that with any. You could pick which classes you want to take the bonus depreciation on. And if you don't want to take 100%, you could take 30%, 50%, 60%. You could take whatever number, right?
There are some specific numbers they have to take, but yeah, it's very flexible.
Somebody says, who files the 3115? Your accountant files it with your tax return. So if it's a partnership tax return, they would file the 3115 with the 1065. If it's your 1040, you'd file the 3115 with your 1040.
And just to mention, Toby, that form is something that's filled out as part of, it's a 9-page form that sometimes they charge as much as $1,500 for that form, but that's part of the service with us. We provide that form, so you just hand it to your CPA. They love it. They don't do enough of those forms to be familiar with it, so they love when they have us do them.
Somebody asked if they already did a cost seg study like last year, the year before, should they redo it, or probably no reason to redo it? Right?
Yeah, you can only do a cost seg study once. So once you do it, you're basically setting up the depreciation schedule until you sell it or until it expires, until you hit the 27 and a half years. So every time it changes hands or has a step up in value, that's when you would redo the study.
All right, client says, I have multiple properties that I would like to have cost study analysis completed for. Should I complete multiple forms on the Anderson CSA link? So if they just do one, is that enough to get you started? Or
yep, if they do one, that'll give me their contact information, and I'll be contacting everybody to go over the specifics. So yep, just do one. And I think there's a spot there for notes. Just say I have multiple properties, and we have some forms that they can fill out that makes it easy.
Somebody says, can I depreciate properties owned by my LLC on my personal income if I'm the sole owner of my LLC? It depends on whether it depends on if you're a real estate professional. Otherwise, it'll be that LLC is just going to go on your Schedule E and offset your other Schedule E income that's from rental properties. Does it make sense to do a cost seg on a property that was 50% burnt and rebuilt with insurance proceeds?
Possibly. again, we'd have to run the numbers, but we've done a number of homes that were burned out and did the cost seg studies on the remodels, and it worked out very well.
Jenny's asking for the solar. You don't do a cost seg on it. You don't have to. It's equipment, so you get to write that off 100%. But you get a solar tax credit of 30% of the cost of the panel plus its installation. So if it costs you $30,000 to install a solar panel on a rental property, you get a $10,000 tax credit. That's not a deduction. That's a tax credit. So it's just cash in your pocket. Plus, on that $30,000 property, you're going to get to write off, what would it be, $26,500 on your tax return too. So you get the best of both worlds. It's ridiculous how much you get when you put solar on a rental property. All right, Tax Tuesday. Hey, if you guys like this stuff, by all means, join us for Tax Tuesday every other Tuesday. You can go there at Anderson Advisors Tax Tuesday. Again, it's free. It's fun. If you like that sort of stuff, if you like this sort of stuff, let us know. We'll keep bringing guys like Eric on if you guys like it. There's Eric Oliver. Look at his pretty face. There's my ugly mug. I want to just say thank you guys all for attending. Please fill out the cost seg analysis form. I thought we were going to be done in 45 minutes. I think the money was on the over on this one.
Hey, Toby, can I just add one thing before you get us on? And I hope this is okay, Toby, but I'm not here to plug you guys, but I kind of am, because we work with a number of CPAs across the country, and I can't tell you how important it is to work with a business advisor and a tax preparer who understands real estate. You know, I've been doing this for 4 years now, and I was shocked at how much money gets left on the table by not having the proper people on your team. And so just kudos to you, Toby, to you and your team. You guys are exceptional. And like I said, I know we're not here to plug each other, but just working with you guys, these guys are top notch. And I just wanted to put that out there.
That's really nice, Eric. I'll give you $10 later.
Toby.
No, hey, you guys, there's a bunch of other questions. Oh, somebody says Eric's email address is, Cost Seg Authority. Is it .com?
It is .com, yeah.
Look at me. You just can't, like, I'm just bad. Here, I'm going to put .com. There we go. Yeah, so you can go to Eric at costsegaauthority.com. You guys, if you have questions, go ahead and email in the cost seg, or email Eric, or email me, and I'll answer your questions. The way I look at it, like, if you guys know Tax Tuesday, it's spreading tax knowledge to the masses. We believe in that. I believe in that. We just try to make sure that everybody makes knowledgeable decisions. If some of you guys are like, why are you guys doing this cost seg stuff? Well, it may not be for you. In fact, if you're really negative on it, then maybe it's not going to give you any benefit. But it doesn't hurt to see how much it could actually save you. So you go in with your eyes open. There's lots of things you could do that we pass up on, saying, I don't really want to do that. It's not going to be enough bang for the buck. You get to decide. That's the beautiful part. You don't let other people decide for you. If I could get 3 times, like we were talking about this earlier, one of my property managers used Eric without me even referring him over. He just happened to know about cost seg and listening to my mug on a Tax Tuesday, and ends up going out and looking, and somebody refers over and says this is the best company, which is always nice when the company that you refer is what everybody else is thinking as the best company. And in his case, it was a 3-to-1 return. He was willing to spend $4,000 to save 12. Nothing wrong with that. It's always, again, worst case scenario is a tax-free loan or an interest-free loan. So I always kind of look at that. Somebody says primary residence, solar system, can you do cost seg? Jenny, it has to be investment property. So you can still get your tax credit. You get a big old tax credit for doing that. But I think the rest of them are has to be investment properties. Anyway, so there's a whole bunch of people asking questions. What you do, see, shoot, we are all 2019, I'll do this. Oh, look at this. So they're asking, you can still do cost seg for 2018. So you guys are not too late. You're just really close to being too late. So you want to jump on it. For 2019, you got plenty of time. But at the end of the day, ask Eric. This is what these guys do. It's all they do. Yes, you can do cost seg for 2017. Yes, you can go back. Yes, we could go back on properties 10 years. Yes, you can go back on properties 5 years. So like, it's not too late. You can absolutely do this. The tax laws are a gold mine if you know where to search for the gold. And Eric is a professional gold digger. Anything else you want to add in there, Eric?
No, that's it. And like Toby said, please use me as a resource. I'm happy. We don't bill by the hour or anything like that. Please use me as a resource. Call me if you have any questions regarding cost segregation or depreciation. We're happy to help you.
All right. Thanks, guys, for joining us. This recording will be made available. Share it with all your friends and spread the word. There's gold in them there hills.